right. On that note, Avi Gilbert is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him and a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. Thanks so much for being here, Avi. The floor is yours.
Thank you so much for having me. Good afternoon, everybody. And let's. The heading of this presentation is where the metal's heading in 2022, and I am not going to surprise you. I am going to say I think it's going up, but the question is, where is it going to? And that's what we'll go through a little bit here. Before I do that, I'm going to give a little bit of a primer to everybody that may not know who I am. I am what you call an Elliottian. What is an Elliottian? An Elliottian is somebody who utilizes Elliott wave analysis. Now, there was a gentleman named Ralph Nelson Elliott back in the 90s who identified that the market was patterned and it's fractal in nature. What does it mean by fractal in nature? Well, it means that the market, the patterns are variably self-similar at all degrees of trend. Now that sounds like a very fancy saying, but let me try to explain what it means. It means that Elliott identified that markets move with a trend in a five-wave structure. So within a five-wave structure, as you could see, you have waves 1, 2, 3, 4, and 5 in Roman numerals. But what Elliott also discovered was that, by the way, waves 1, 3, and 5 move with the trend, and waves 2 and 4, as you could see from this chart, move against the trend. Now, what Elliott identified when it said that markets are variably self-similar at all degrees of trend, it means that each wave within the primary trend, so waves 1, 3, and 5, break down to five-wave structures themselves. You see here wave 1, 1, 2, 3, 4, 5, wave 3, 1, 2, 3, 4, 5, and wave 5, 1, 2, 3, 4, 5. And you can keep breaking it down like this as you keep moving lower and lower and lower in time frame, or higher and higher in time frame. That really is the main thing that Elliott identified. He also started utilizing, towards the end of his career, he started utilizing Fibonacci mathematics to identify the wave proportions as they're proportionate to each other. Now, why did he use Fibonacci? Well, if anybody knows anything about the way the world was created, a lot of what the world creation is based upon is based upon what they call the golden mean, the golden ratio. And that's really the basis behind Fibonacci mathematics. Now, there's so many things I can go through in the world that to identify to you, that is built upon those mathematical ratios. The helix of the DNA, the way your body is divided between your belly button and your upper body and your lower body. I mean, there's so many things throughout all of nature that are governed by Fibonacci mathematics and those ratios. So why wouldn't our, and they call it the natural law, by the way. So why wouldn't our mentation, the way we think, the way we act, also be beholden to those same ratios? And believe it or not, over the last 30, 40 years, many studies have actually proven that yes, it is true that our thought processes, the way in which we make determinations between various things, also revolve around Fibonacci mathematics and that golden mean. So we utilize that information to identify how the market's going to move. Now, some may think that that's voodoo, some may think it's hokum, but I got to tell you, people that have followed me, I've been doing this now for over 10 years publicly. And one of the first public pronouncements that I ever came out with, or announcements that I ever came out with was I was looking for a major top, and this is around the summer of 2011. I'll show you this. Around the summer of August 11th of 2011. This is the first market prognostication that I publicly came out with. And what I was looking for, if you remember back in 2011, gold was rallying parabolically. I mean, it was $50, $60 a day. I mean, it was in a parabolic move. And all the gold bulls and gold bugs were slapping themselves, giving themselves high fives and loving every day of it. And there was a big argument that ensued, if you remember. What was the argument? Well, how soon are we going to get through 2000? Or how high beyond 2000 are we going to go? Ultimately, there was true certainty that the market was going past 2000. Now, I went back and I scrubbed the charts, and I actually used 100+ year analysis utilizing Elliott wave analysis and Fibonacci mathematics to analyze the gold chart. And I came up with a potential top at 1915. And this was when the market was still several hundred points below that level. And I came up with a top at 1915. That's what the chart told me. And I published it. And this was my first market prognostication published. And oh my God, did they let me have it. I mean, I was brutalized in the comment section. But as we now know, I think I missed the top by $6. I think the top in 2011 was 1921. What was even funnier was I used the same methodology, and I said, if this top confirms for me by breaking down a certain level, then my downside target is between $700 and $1,000. Now, if you thought I was skewered by saying we're going to get a top at 1915, can you imagine how much more skewered I was when I said, well, I'm looking down by at least 900 points. I mean, I felt like I was completely trashed by the comment section. And remember, this was early in my publication career, so I really didn't have a lot of experience with this. So I wasn't really sure what to make of this. But you know, as we now know, the market came down to as low as 1,050. And the same analysis, again, the same analysis methodology, folks, in late December had me writing this. And I put this out to all of our clients, and later I put it out publicly. And as you can see, as we move to 2016, I believe there's a greater than 80% probability we'll finally see a long-term bottom forming the metals and miners, and the long-term bull market resumes. So those that followed our advice in 2011 and moved out of this market for the correction we expected are now moving back into this market as we approach the long-term bottom. In 2011, before gold even topped, we set our ideal target for this correction in the 700 to 1,000 region in gold. We are now reaching our ideal target region, and the pattern we've developed over the last 4 years is just about complete. For those interested in my advice, I would highly suggest you start moving back into this market with your long-term money. I think we pretty much nailed that. In fact, for those of you that are from Seeking Alpha or from Elliott Wave Trader, you probably know the name Doug Eberhardt. And I was actually, the night that gold hit 1,050, I actually called Doug and I put in another order right then and there to buy my last order of gold. And gold has not reached, did not drop any lower than it did that night when we made that last order. And I told all my clients I was doing the same thing. A bunch of them got from Doug as well. And but this is really the power of Elliott wave analysis. It really is it takes you out of the market sentiment. Now, if you remember, not only in 2011 was the sentiment extraordinarily bullish, in 2015, those people who were formerly bulls, it took them until about 2014 to turn bearish. And that was what amazed me. So from 2011 all the way down to 2014, they remained bullish. Silver dropped 70% of its value and people remained bullish. It wasn't until we got into about 2014 or 2015, around that time frame, that people started turning bearish, and everybody started assuming, just like they assumed the market was going to go over 2000, it became unanimous almost. It was ubiquitous that the market was going to drop below 1,000 in gold. Well, I think we all know how that turned out. But the whole point of me telling you this story is we utilize mathematics to avoid the problems that everybody else does. We utilize mathematics within our methodology to be able to identify where those major turning points are, or at least potentially reside. And we look for confirmation, of course, but we utilize mathematics and we try to take out emotion. So, a long time ago, one of our long-term members said this, and it really is what we do. The goal of Elliott wave analysis is to analyze sentiment and not necessarily to participate in it. Because when you participate in it, you get caught up in the crowd, and you get caught up at the highs and get caught up at the lows. And that happens so often. And this applies to every single market you trade or invest in, every single stock you trade or invest in. It applies across the market. Do not get caught up in the sentiment. Understand where you are within the sentiment trend and utilize that to your benefit. So let's move out of the presentation and let's start looking at the metals. Where do we reside? Now, as I said, back in 2015, I remember we rolled out in September of 2015, we rolled out a service on Elliott Wave Trader that we called our mining stock service, where we identified those stocks in the mining industry, in the metals mining industry, that we thought were a great opportunity to buy at the time. So we rolled out that service, and we started suggesting, buying certain stocks. For example, I bought Barrick Gold, and I think when it was either just below $7 or just over $7. I don't know where it is right now, but it's significantly higher than that. So we rolled out, and people thought we were crazy for buying those stocks. Well, it's turned out to be a really, really good buy from a long-term perspective, because a number of those stocks, I think, are 3 or 4 times where we bought them in late 2015. How many things do you know that have gone up 3 or 4 times since 2015? So, they were great opportunities, and I think we're starting to approach the long-term potential for topping, believe it or not. But as you could see, the yellow all top at the up there. But I'm going to show you where I think we are right now, and I'm going to try and keep this relatively short. I'm going to try and go through my charts right now in a relatively quick way. I'm going to go through the GLD chart. I'm going to go through the silver chart as well as the SLV chart, because I have 2 things I want to show you on those. And I'm going to go through the GDX chart pretty quickly. So I'm going to spend the next 5 minutes going through those, and then I'll leave some time to take some questions, because I think we only have a half hour total together. So looking at the GLD chart, I'm going to tell you very simply, my expectation is clearly my next target is right here, about 202 to about 207 on the GLD. That's my next target on this rally. Assuming we hold this low that we hit in late March, as long as that low hold, I'm looking for a rally to take us up towards the highs. And this is just a major high that we've struck many times already. And I'm looking for us to break out through that high and head to about 202 to 207. Now, one of the things about the metals that you really have to understand is, remember I showed you we have 5 wave structures, and in equity markets, the 3rd wave is often the strongest move in the equity markets. However, in the metals market, it often is 5th waves are usually the strongest moves you'll see. So as you could see, this was a 3rd wave, and now we had a 4th wave pullback right down to the pivot I outlined for our members. Now from here, if assuming we do get that breakout and we hold that low, I think you're going to see a very strong rally in a fifth wave of this third wave. Remember, markets are fractal in nature, all different degrees, and it applies in the same way. Now, you're going to hear me say a lot of if-then analysis. The reason I do that is because there is nothing guaranteed in life. And our markets are non-linear environments. So anybody that maintains a perspective that something must happen, I am sorry, you should never listen to that person again. And I'll give you an example. You know, when you deal with gold bulls or gold bugs in general, when the market dropped from 2011 to 2015, what did they say? They say that the market was not supposed to drop. That's not the way it should happen. It was manipulated. And I am sorry, that is a bunch of hokum. I've actually written a multi-page article that outlines every single one of their arguments and exactly why they're wrong. You know, when you are caught with your pants down, you have to come up with a reason. And they came up with the manipulation reason. They came up with a lot of great support, they think, for it. But if you look at their support, they're only half supports. They only tell you half the truth. They look at the cases that have come up against some of the big banks for manipulation, but what they don't really go into is that the manipulation cases that we're dealing with are for something called spoofing. Spoofing is something where you're actually playing with the bid ask, and you're dealing with making money on pennies or fractions of pennies. Working on fractions of pennies is not going to cause the market to drop 70% in the silver market. So I've gone through this many times. If you want to look up my article, the article is something to the effect of where the metals market manipulated to drop from 2015 to 2011, something like that. You can look it up. I went through all their arguments ad nauseum and showed how they were just dealing in half truths. They had to come up with a reason why they were wrong and the market was going down. Manipulation was the easiest thing. So I'm telling you straight out right now, anybody that tells you market's going to move in a definite way, do not listen to anything they say, because they're complete full of BS. Markets are non-linear, meaning they move up, they move down. There's nothing definitive within markets whatsoever. So we approach markets from a perspective of non-linear. Our analysis is non-linear. So we have to look at it from if-then logic, because if the market does not do as we expect, what do? We utilize our if-then analysis for risk management purposes. I am not, like most people, I am not going to hold a position that's going to drop 70% because I think I'm right. If the market is telling me something because it invalidates a structure that I've been tracking, it tells me, well, now's time to utilize your risk management plan and cut your losses. Our losses are very small, and we let our profits run to our targets. So we utilize this if-then analysis for risk management purposes, nothing else. And ultimately, that keeps you in the game. So I'm sorry I went on about that, but I think it's very important because very few people really utilize risk management appropriately today. So like I said, as long as we hold the end of the September low, I'm looking for a nice big rally to begin, and it could be quite strong. That's the GLD. I'm going to move over to, I got a lot of other charts. Let me show you. Okay, I'm going to show you the SLV chart in a larger time frame. I'm going to show you a weekly SLV chart. There's a weekly SLV chart. Now, I'm going to be honest with you about something. The structure in a lot of these metals charts are very sloppy, very sloppy. I love trading metals. Come out and say, I love trading metals. They adhere so nicely to the Fibonacci structures, and they give you such incredible opportunities to make money, assuming they abide by our Fibonacci pinball structure. I would say that of late, and the same thing in gold, of late, the structure has been extraordinarily sloppy to the point that I'm not willing yet to be doing any aggressive trading on the long side in the metals market. And it's because the structure has been so sloppy. So what is it going to get me? And by the way, it doesn't mean I'm not long. I told you I went heavy in the end of 2015 into the mining stocks. I bought a ton of gold, not exactly a ton, but I bought a lot of gold. I bought a lot of silver. I'm still long all of it, and I have no intention to selling any of it at this time. However, there are times I like to also trade. I have not been given a solid small degree structure to trade with because of how sloppy it's been. So I'm still waiting for the market to give me that opportunity. And what I'm seeing in silver potentially could give me that opportunity in the coming months. I'm looking for a higher high over the coming weeks in silver, followed by a pullback. If I get this if I get this structure to develop, I will have a tremendous opportunity for a nice aggressive long trade. It's probably pointing us here. So this is my larger degree expectations. In the near term, I'm clearly bullish on silver. Let me show you my my smaller degree silver chart on the futures. Again, very, very sloppy. As you could see it, well, if you understand Elliott wave, you would understand this is a very sloppy structure. So ultimately, if we're able to move through this resistance here, so I've got that highlighted, that's the resistance, then what I'm expecting is a rally, a pullback, and then a rally, and that would complete that initial move that I was pointing on the SLV chart. Thereafter, seeing a sizable multi-week to multi-month pullback, which would set up that major rally I still want to see later this year. That's the rally that I intend on getting very aggressive on, assuming we get that set up. If you could use 29 in the futures on silver as your ceiling. If we take out 29, it means that major rally is beginning sooner than I expected. But for now, my expectation is we're going to hold below that 29 ceiling and see a multi-week to multi-month pullback later this year. Let's go take a quick peek at the GDX, and I'll show you relatively the same thing. I think the GDX, my next target on the GDX is in the 45 to 40 to 47.5 region. Once we get up to that region, I think you'll probably see multi-week to multi-month pullback, and then we will continue higher. Ultimately, I'm expecting that, we should be able to get up to about the 55. Depending on the extensions we see, because like I said, metal sees some strong extensions, but over the next year, my expectation is somewhere in the 55 to 57 region minimally is my expectation over the coming year. We could blow that out. Ultimately, I think we can get as high as 67 to 80. Again, all depending on extensions. Remember I said fifth waves in metals are very, very strong and often see some major extensions. So that's my general perspective over the coming 12 months or so, and how I see it breaking down over the next, for the rest of the year. I'm expecting another rally, a multi-week to multi-month pullback, followed by another rally as we look out towards 2023. I think I'll stop now. We have a little bit of time for questions, right?
Avi, great presentation. Yes, we do have time for a few questions here. So let's get right into that. First question we've got is, how is Elliott Wave's technique been performing in black swan scenarios that unpredictably change people's sentiments?
Okay,
the
basis behind your question is wrong. Sentiment is driven biologically. There have been many, many studies over the last 30, 40 years that have shown us sentiment is driven biologically. It is not driven by exogenous factors. So, you're going to look at black swans. I don't consider anything a black swan. Whereas you may be surprised by the market's reaction. I have not been. A black swan is often thought of as a news event that will affect the markets in an unexpected way. I can't say that there's anything that I've seen that has been unexpected in the market in general. but I don't know what the news events are going to be. And I'll give you a perfect example. Perfect example was what happened with COVID. Well, you know what? The market rallied. My expectation in 2019 was the market was going to rally. The S&P rallied beyond my target. The IWM and the EM rallied exactly to my targets. And both of those were telling me to look for a 30% decline, which could happen in the first quarter of 2020. Now, I did not expect it to happen as fast as it did, but that decline that we got in March of 2020, in February and March of 2020 was absolutely foreseeable in the charts. But did I know what news they were going to assign as the reason for it? And I'm using my words very carefully here. The news they will assign to the reason for it. News is often utilized after the fact to give you an excuse for a market move. But now, if you want to think about this honestly, how often have you seen a news event? The substance of the news event tells you the market should rally, but the market declined, or vice versa. The substance of the news event told you the market should have declined, but the market rallied. News events can act as a catalyst, but the substance of the news is not necessarily going to be indicative of the direction of the move. A news event can act as a catalyst, but not necessarily will provide you with direction. Oftentimes, markets move exactly in opposite of the direction. So when you're thinking about a black swan, great. I'll agree with you. I don't know what the news is going to be, but I'm going to tell you that I don't think I've been surprised by a market move of any major degree in my career yet. So I hope that really explains my perspective on the quote unquote black swan.
Great response. We've got another question here. Avi, do you see direct correlation between GLD, SLV, GDX, or they won't keep similar pace?
They won't keep similar pace. They can move, they may not move in similar directions. Sometimes one will sit, the other times another will rally. I'll give you the best example. And I say this all the time, each chart on its own. You have to analyze each chart on its own. I'll give you the best example. Again, if you remember 2011, in 2011, does anybody know when silver topped? I'm not seeing any of your responses, so I'm just going to come out and tell you. Silver topped in April of 2011. Gold didn't top until 5 months later. Gold kept going parabolically while silver was just meandering below its highs. So, and then look at what happened in 2015. In the fall of 2015, a lot of the miners were bottoming and started rallying off those lows. It didn't happen until I think it was the last week of December that gold actually hit its bottom. And I think, if I'm right, silver didn't hit its bottom until 2020. So, each chart has to be analyzed on its own.
Great response. We've got one more question here. Avi, do you have a monthly count on gold that you can share?
I actually don't have a monthly. One of my analysts actually has, because he has a really nice, clean, long-term chart on it. So I don't have it here now. If you want to come to our site on Elliott Wave Trader, you can ask Garrett to share his. He's the keeper of that long-term chart.
All right, very good. Well, thank you so much for fielding these questions. Thank you so much for an awesome presentation. Thank you to all the attendees for attending today's lectures, and great presentation, Avi.
Thank you so much for having me, and have a wonderful afternoon, everybody.